It's time to get started. For those of you who don't know me, I'm Denise Timler, a partner and financial planner here at Protected Investors, and I'm so pleased to welcome you to our webinar about the potential tax policy and legislative changes coming with President Biden. We get a lot of questions about this. First, a brief housekeeping message that for compliance reasons, we can't use the chat. So just send us an email if you have any questions and we'll make sure we get it answered. The webinar is going to be recorded and we'll send out a link afterward. And the session will last approximately 30 to 45 minutes. All right, so now to introduce Leslie Geller. She's here to help us make sense of the news swirling around new potential legislation. She is a wealth strategist at the Capital Group, home to American Funds. She has 13 years of industry experience. Prior to joining Capital, Leslie was a partner in a firm where she advised high net worth and ultra high net worth clients on all matters related to taxation, wealth transfer, and family governance. She received an LLM in taxation from New York University School of Law, a JD from Boston College Law School, and a bachelor's degree from Washington and Lee University. Leslie is based in Los Angeles and has 3 daughters who will appear on the screen if we're really lucky. Fingers crossed. It's like the best part. All right, welcome, Leslie.
Thank you so much, Denise. And I actually completely disagree with that. I am always hoping that they don't come in, but it's touch and go. It's day to day. My 2 oldest are actually in school where they should be, thank goodness. But my youngest may show her face, although usually you just see like a little fuzzy head hovering by my side. All right, so we're going to do 3 things in the next 30 minutes or so. I'm going to give you a brief policy update on what we hear going on in DC, what we anticipate actually potentially changing by the end of the year as far as taxation goes, especially around corporate taxes and taxes on high earners. Then we'll take a pause for questions. Then I'm going to go through some of the planning concerns around the new legislation we have that's already in effect. So the Secure Act, which was a big piece of retirement legislation that took effect last year. I'll also hit on Prop 19, which is a California-specific issue, all about property tax reassessment and the parent-child exclusion. Again, we'll pause for questions, and then I'll wind up with some really actionable planning conversations that you can have with Denise, Sharon, and Lev and the team, all about wealth transfer, income tax mitigation, just because we have a lot of uncertainty, and that will be the theme you'll see in my comments, it doesn't mean that we have to be paralyzed, right? We need to be having these conversations to prepare for the potential for change, even if that change doesn't actually happen. So I'm going to get going, and as Denise reminded everybody, email questions. That's the way we will get them, and we'll try to answer all of them. Okay, so policy update. I have been fielding so many calls from advisors that we work with and investors, and telling everybody to take a big deep breath, because there's a lot of scary proposals out there, particularly for high net worth investors around taxation. So Biden proposing doubling the capital gains rate from the current 20% to almost 40%. Biden proposing taxing unrealized capital gains at death, right? That's a huge departure from the current tax system we have. I'll get a little bit more into that in a second. But there are some pretty paradigm shifting proposals out there. But what I've been counseling everyone is we need to remember that we are very much at the very, very beginning stages of all of this. What Biden put out there with the American Jobs Plan, that traditional infrastructure package, and the American Families Plan, that human infrastructure package, both of which include pay-fors that increase taxation on corporations and the wealthy, those are not proposed legislation. It's not framework for legislation. It's Biden's wish list, right? It's what the White House would like the pay-fors to be once Congress drafts this legislation. So as I said, we are at the very, very preliminary stages of all of this. And so we need to take this with a grain of salt. And, you know, looking at some of the things that Biden has proposed, right? And looking at the amount of time we have left in this year, even if you take policy and politics out of the predictions, out of the discussion, if you just look at things from a timing or logistics perspective, it's hard to see how particularly the individual tax increases that are proposed in the American Families Plan, how they have time to get to those, right? And let me unpack that a little. So right now, they are in discussions over the American Jobs Plan, which is that traditional infrastructure package, right? Roads, bridges, broadband, everything that we think of as traditional infrastructure. $2.3 trillion proposal, really massive, proposed to offset with corporate tax increases, both the rate, right? Biden's proposing a 28% rate. We're currently at 21, as well as changes to the way multinational corporations are taxed, right? So some really big changes there. Right now, they're in discussions with the Republicans to see if they can get a bipartisan deal worked out, right? They would like to pass some version of this with bipartisan support through the traditional legislative process. But that will require at least 10 Republican senators, possibly more for cover, right? 12 to 15, to get on board with some version of this package, right? I think we'll know a lot more in the next week or two about whether this bipartisan effort really has any legs. And I think that will then inform how big the changes are going to be on the corporate taxation side, if any. If the Republicans stay in the mix and they move forward with this bipartisan effort, right? Our lobbyists think, and I agree, that we likely won't see a corporate tax increase because the Republicans are a no-go on any tax increases. And if they remain in the discussion, likely this part will be deficit financed. If bipartisan discussions fall apart, and it's looking more and more like that's going to happen, apparently the discussions in the last few days have not gone very well. If the bipartisan effort falls apart, the Democrats will go it alone. They will have to do this through budget reconciliation, that shortcut legislative process that just requires those 50 votes in the Senate, right? So they will do it through that shortcut legislative process, and they can do what they want with the corporate tax rate. And so we'd probably see a corporate tax bump, not to the 28% that Biden wants, but more around 23 to 25%, right? Joe Manchin has said 25% is my limit. And so I think once we see what happens with these bipartisan discussions, we'll know more about the size of that American Jobs Plan, right? And what those pay-fors could look like, if any are included. But even if everything goes swimmingly for the Democrats, whether they do it through bipartisan effort or budget reconciliation, they're not finishing up with the American Jobs Plan until September, right? And that's best case scenario. Then at that point, right, and that's the earliest possible time they can do it. Realistically, they don't finish up with the American Jobs Plan until beginning of Q4. And only then will they take up the American Families Plan, which includes all of those potential changes to individual income taxation for high earners, right? And it's hard to see how they can get that done in the fourth quarter, right? Think about the fourth quarter. You've got the debt ceiling, you've got the holidays, all the congressional recesses, right? There's a lot going on. And that's not even taking into consideration some of the potential surprises we could have come our way. And if we've learned anything over the last few years, is that you can't discount the possibility of some of these really big global or national events that affect the markets, affect legislation, events that affect the timing of all of this. So even taking out the policy and politics, it's hard to see how they get to the American Families Plan, especially in the form that Biden wants it. So as I've been telling everybody, we can take a big, deep breath there. There is a chance they realize that they're too crunched for time, and they squish everything together into one big package, one big traditional and human infrastructure package, water it down significantly, right? And then jam it through in one big budget reconciliation package before the end of the year. And they want to get this done before the end of the year because what happens in 2022? It's the midterm elections, and a really important one at that. And so the chances for passing anything, especially something that includes tax increases, falls drastically. So whatever the Democrats are going to do, they are going to do this year. And so for that reason, we're really not anticipating any of these changes passing in the form that Biden has proposed, right? So he proposed doubling the capital gains rate for people earning over $1 million or more. For policy economic reasons, that is not particularly feasible, right? We just talked about why for logistical reasons, any change like that is not feasible. But we could see a slight bump to the capital gains rate, right? It could go up to 23% or 25%, right? I think with respect to the treatment of capital gains at death, right? Right now you get a step up in basis upon death, which means that your heirs take the asset at fair market value basis, which means that if they go and sell that asset, they have little, if any, income tax consequences. It's a huge tax benefit for wealthy families. Biden is proposing taxing capital gains at death as if you sold the asset, even if you didn't sell the asset, right? That is a huge, huge proposal. My gut is that that is too hard to do right now, right? Even if they limit it to very large estates. So my gut is that they abandon that proposal and instead go for changes to the estate and gift tax exemption amount. So right now, the estate and gift tax exemption is almost $12 million per person, right? It's 11.7. That means you can pass up to $12 million without the imposition of the gift or estate tax, which is at a 40% rate. That is historic in its size, right? Biden has been proposing going down to between 1 million and 3.5 million of exemption. So think about that. Think how that would shift the potential implications of estate tax for those lower or middle high net worth families, right? That is a huge demographic down market shift in those who would have to think about tax efficient wealth transfer. And it's a lot easier to change the estate tax exemption amount than it is to change the treatment of capital gains at death. And one of the big reasons for that is that the exemption amount is already set to go down to about 6 million at the end of 2025. That's already on the books. So an acceleration of that timing plus an increase in the amount of the reduction doesn't seem to be that big of a political lift, especially compared to changing the treatment of capital gains at death. And so I think, just to hammer this home, like we are very much at the beginning stages of this. My favorite term over the last few weeks has been be a goldfish with respect to some of this, which is a reference to goldfish's very short memories, right? They forget everything every second or two. And so until the fourth quarter, be a goldfish. But at the same time, that doesn't mean that we should be ignoring the potential for change here, right? We have to pay attention to this and have conversations that make sense anyways, right? They make sense irrespective of change, but maybe they have a little bit more urgency because of what we could see happen, however unlikely or however watered down it is, right? Because it is out there. And as I've said, it's hard to make predictions, particularly around tax policy at this moment. Denise, any questions, any particular topics you want me to go into a little bit more before we move on?
I haven't had any questions. Oh, wait, I just got a question. How funny that person for the state tax downgrade from 11 million to 6 million. If we file an estate tax filing, do we get grandfathered into the 11 million?
So that's a really great question. So the estate tax is a use it or lose it thing. So if you use it, right, if you use your full 11.7 million and then it goes down to 3.5 million, which is what Biden is proposing, or it goes down to 6 million, which is what is set to happen at the end of 2025, that's too bad for the IRS, right? Because you've already used and locked in your 11.7 million exemption and no one can take it away from you. So yes, you get grandfathered in. That is a very important change. And a corollary of that, and I get asked this all the time, is when would any of these tax changes take effect? Do we have a chance that there's like retroactive tax legislation that is passed at the end of 2021 and is put into effect for 2021, right? So it doesn't take effect January 1st, 2022. At this point, no, there is an incredibly minimal chance of retroactive tax legislation. We're too far into the year. There's constitutional issues with it. So the earliest any of these changes could take effect, including a reduction to the lifetime exemption amount, would be January 1st, 2022. And even then, we think some of the bigger changes would be gradually phased in.
All right. Just a second, a couple more questions coming in. So Yellen and Biden have discussed a global corporate tax. How likely or real is this idea?
I mean, this is one of those things that is a really nice idea, but it's hard to see how you could actually implement it, right? Who's going to police it, right? Who's going to be in charge? And it sounds like there are a lot of countries who would be on board with it, but there are also countries who wouldn't want to be on board, who still make up a big part of the global economy and this global tax issue. So it would be hard to see for me how logistically, without a huge multinational effort, they could do this, right? They'd basically have to come up with a WHO type organization, a World Health type organization for this global taxation. So it's hard to see how, with everything going on in the world right now, that's actually a feasible thing. I think if the US wants to change how multinational corporations are taxed in the US income tax system, they're going to have to do it through the US income tax system. Even that is a chore, right?
Yep, that was a big ask.
It is. It is.
All right. I think those are all the questions.
All right, great. All right, so let's take a pause and move into pause from the potential for change and look at what has actually changed this year. So a couple areas relevant for people on the call. So first of all, we had the Secure Act, which took effect last year. And the Secure Act was this big piece of retirement legislation that was passed in 2019, took effect in 2020. It was a really big deal for the first couple months of 2020. I was flying all around the country giving talks about the Secure Act, and then the world fell apart because of COVID, and everybody forgot about the Secure Act. And so we're in this really funny place with the Secure Act because it is a really big piece of legislation. And normally, a year and a half into having this type of legislation take effect, there would be significant scholarship on it. There might be proposed regulations from Treasury. All of the unclear provisions would be cleared up. But because of what came in March 2020, right, because of COVID, all of that didn't happen. So we're at this very stunted phase in the Secure Act's interpretation and growth. And we're still in this place where there's a lack of clarity with a lot of really important provisions. And the Secure Act did a number of things, right? It bumped the RMD age to 72. It enabled you to make contributions post-retirement, which was not used for traditional IRAs, which didn't used to be allowed, made a number of other changes. But the really big change from a planning perspective, particularly for people who have a lot of retirement assets that they don't need to live on, is the change in the tax treatment for inherited IRAs. So it used to be that you could pass down your IRA to children, grandchildren, whomever, and they would get to take the distributions from that account over their remaining life expectancy, right? And depending on the family, depending on the beneficiary, that was, a tax benefit, right? You got to spread those distributions and pay the tax on those distributions over an extended period of time. Now, most non-spouse beneficiaries are subject to the 10-year rule, which means everything inherited in an IRA has to come out within 10 years of the owner's death. Now, again, depending on the particular family situation, depending on the amount in that retirement account, depending on the age of the beneficiary, that may not be a big deal. But if you have significant retirement assets, right, and your beneficiary would otherwise have been to extend the distributions of that account for 30, 40, 50 years, right, because of their age, the 10-year rule is now a really big problem. It impacts the tax efficiency of passing down retirement assets. Retirement assets have never been super tax efficient to pass down. They were always the first place I looked to make charitable contributions during life or at death when a client was charitably inclined. But now they're even more tax inefficient, right? And not just because of the Secure Act, but because of all of the potential policy changes, right? Because of the potential for income tax rates to go up, because of the potential for the estate tax exemption to come down, right? That's a big one. A lot of people don't realize that your retirement assets are also included in your taxable estate upon death, right? And that's not a big deal for most people, for most even high net worth people, when the exemption amount is almost 12 million per person. But if the exemption amount goes down to 3.5 million, right, or the exemption amount goes down to even 6 million, there's going to be a lot more high net worth individuals who are going to have to think about what happens when their retirement assets are included in their taxable estate. And so if you have significant retirement assets and that is part of your planned legacy to your children and grandchildren, you don't need them to live on, you need to get with Sharon, Denise, Lev, you need to review your beneficiary designations You need to review the plan for the distribution of those assets and what the taxation of those assets would look like upon your death when you pass them down, right? It may be that you don't need to make any changes, but right now, because of the Secure Act and the new 10-year rule, because of the policy uncertainty, it is an absolute imperative that you have that conversation. And the more retirement assets you have, the more important it is. I can't emphasize that enough. And the estate planning attorneys, the tax professionals, they're not paying the attention to it that it needs. And so really talk to your advisor. They will help you get started on that review. Even just a simple beneficiary designation review is going to be beneficial right now because of all the change we've had and could have down the road that really could impact the legacy associated with retirement plan assets. Second big piece, or second piece, I don't know that I'd call it big. Second piece of legislation that that took effect in 2020 that's probably important for people on this call is Prop 19. Right? And Prop 19 is part of our lovely California property tax system. And it passed by a very slim margin in the elections last year, very slim margin, like a percentage point, I think, maybe not even. And what it did is it changed and drastically limited the parent-child exclusion from property tax reassessment, right? So we have Prop 13 here in California, this very strange law that people who live anywhere else don't understand. And it provides that property taxes are limited to 1% of the assessed value, and the increase each year is limited to 2% per year. That's, for people that have held property for a very long time, that is a big benefit when you consider the increase in property values here in California. Before February 15th of this year, the parent-child exclusion to property tax reassessment provided that parents could transfer a principal residence of unlimited value to their children without triggering property tax reassessment. Usually a transfer of property triggered reassessment. There are a number of exceptions. Parent-child exclusion is one of them. Right. There was also a $1 million non-principal residence lifetime exclusion, which permitted the transfer between parents and children of up to $1 million of assessed value of all other types of property. So not just the principal residence, but second homes, rental, commercial, right? That principal residence one was a big one though. So that means if you bought a home in Laguna Beach for $200,000 50 years ago and it's now worth $15 million, right? You could pass that property to your child and they would still have a property tax base as if you originally purchased it for $200,000, right? It wouldn't be reassessed at a property tax value associated with $15 million. That is a very, very big benefit. Now, Prop 19 provides that to qualify for this principal residence exclusion, the child who received the property is required to use it as the child's principal residence within a year. So before, it didn't matter what the child did with it. They could rent it out, didn't matter, right? Now the child has to use it as their principal residence, not a vacation home, principal residence within a year. And the exclusion amount is limited to $1 million of assessed value. So no longer can you escape reassessment on your $15 million Laguna Beach home, right? Also, there's no secondary exclusion for another type of property, right? That $1 million exclusion for a secondary piece of property is no longer in existence. So it's just the principal residence. Child has to use it as their principal residence within a year, and it's only up to $1 million. So that completely defanged the parent-child exclusion, right? Especially for these families that have had homes that have been in their families for generations. So there was a huge rush to transfer properties from parents to children before February 15th. Now, I've been following this, but there's several proposals that are floating out there that are effectively movements to retroactively delay the effective date of Prop 19. So basically to say that there's all these problems with it. The recorder's office is all backed up. Nobody understands what it means, right? We're all too busy with COVID. It's a big mess. We should delay the effective date of Prop 19, even though it's already taken effect, for 3 years, right? I think those are going to be voted on later in the spring, early summer, but there are a number of those floating out there that actually have some legs. So we're keeping an eye on that. I'm sure Sharon, Denise, and Lev will be keeping an eye on that. But I wouldn't be surprised if also because it passed by such a slim margin, right? I don't think people knew, and there's a theory that a lot of people didn't realize what they were voting for, that they saw not the pay for side of Prop 19, but the benefit side of Prop 19. And the benefit of it, or how it was marketed, is that people who are over 55 who wish to transfer the property tax value of their principal residence upon the sale to a new replacement residence anywhere in the state, right, can do that now with up to 3 times in their lives, right? So that means that there are a lot of people who would sell their homes, they're empty nesters, but their property tax base is really low. They don't want to buy a new home with a larger property tax base, right? Even if it is a smaller home, because again, because of the property values here, that could very well happen. And so the Realtors Association was really arguing for this to build some inventory, right? Free up some inventory, especially for these empty nesters. Whether it will actually do that remains to be seen. But that's, I think, what people saw they were voting for. They didn't quite understand what was going on with the parent-child exclusion. It's an incredibly complex area of law anyways, and taxation anyways. Practicing attorneys have trouble understanding it. So this one is still out there. It's technically in effect. If you want to transfer properties down from parents to children, there are ways to navigate around it and still qualify for other exclusions. Some of them get pretty hairy and complex, but a good estate planning attorney in California will know how to deal with it. And if the numbers are high enough, right, if the difference in property taxes between the current value and what the new assessed value would be are significant enough, a complex transaction may actually be worth it. I always say that here in California, we don't only have to think about balancing the income tax and the estate tax, right, when we're looking at wealth transfer and family wealth transition plans, we also have to think about property tax. And because real estate is often a big part of wealth here in California because of property values, there are some very high stakes numbers involved, right? And so property taxes have to be part of the conversation. So it's really important to work with estate planning attorneys and advisors that understand the implications of some of these transfers. I'll emphasize this, like, this is a really complex area of law. So Denise, do we have any questions? I don't know if we want to get too into the weeds on this.
We actually do have a question. What are the Prop 19 impacts on property already in a trust?
So it depends on what kind of trust. If you already qualified for the parent-child exclusion, right? First of all, if the trust is an irrevocable trust and the transfer's already been done, it's out of your estate, right? Then the parent-child exclusion potentially could have already been filed for, right? And if you already did it and it's treated as a transfer from parent to child that qualified for the parent-child exclusion pre-February 15th of this year, then you're grandfathered in. There are certain trusts where that transfer from parent to children, either because of the structure of the trust, because of the beneficiaries of that trust, is not treated as happening until later on, right? Until one tranche of beneficiary dies or till a certain provision of the trust takes effect. And that means the parent-child exclusion wouldn't be filed until that time. For those people, right, you're out of luck and you're subject to whatever rules are in effect right now as far as the parent-child exclusion goes. If it's a revocable trust, so a trust that is basically you, right? It's a trust being used for estate planning purposes, the trust that holds all of your assets, right? That hasn't technically been transferred yet. And so again, the parent-child exclusion hasn't been filed for, and you're subject to whatever rules are in effect when you die and the transfer takes effect.
All right. Another question. What happens if 2 children inherit the home and only one moves in?
Oh, that's one of the things that is so unclear. That is a fantastic question. I think the way that's being interpreted is that as to half, right? You get the benefits of that $1 million or a pro rata portion of that $1 million exclusion from reassessment. But the half inherited by the other child, right, who didn't inherit, you wouldn't get any. And this is part of the problem with this big change, right, is now you really can't pass homes like that to multiple children because of this principal residence requirement.
That's very complicated because you'd have to figure out then how else you divide the estate.
Yes, exactly.
Proportion of California net worth.
Exactly. It's hard to, like you say, we'll just make up the share, the other share from other assets. But a lot of times, you're dealing with a huge home that's worth millions of dollars that may be the principal asset in the estate. So it's hard to make up the other share. So a lot of people are going to be forced to sell their homes that they otherwise would keep in the family, right? Just to keep things equal.
Mm-hmm. All right, clarification. So once the parent passes, are you saying one of the children can get to move in within a year of their passing to get the $1 million exemption?
So they have to move in. So first of all, the parent has to give it to the child, right? That has to be like in the documents, it actually has to go to the child. And then the child has to move in and use the home as their principal residence. They can't pretend to use it, right? They can't use it as a vacation home, but they really need to use it as their principal residence, right? And there are a lot of different factors that go into that analysis.
All right, well, that was clearly a great topic. I have no more questions right now. Lots of questions.
That's a messy one. Although I think the worst job right now is to live in the recorder's office or to work in the recorder's office where they're dealing with all of these backlog transfers that they're not going to sort through for several years, I would imagine. They're just inviting litigation and confusion. All right, finally, third topic. So we have all of this potential uncertainty around tax policy. We have these big tax changes that we actually saw take effect, right? What are the actionable things we can be doing around our financial plan, around our income tax wealth transfer plan? And all of these require conversations with your team of advisors. So with Denise, Sharon, and Lev and their teams, right? You need them involved in these conversations. And there are really 3 conversations to be having. And just to frame this out before I get into each of the 3, and I'll move through them pretty quickly, I don't like to frame these conversations based on predictions. And I particularly don't like to frame the decisions coming out of these conversations based on predictions, right? So we never want anybody to decide to sell their business or liquidate a security just because everyone's predicting that the capital gains rate is going to go up, right? That never ends well because it may not happen, right? What I like to do is frame the conversations around what already makes sense based on your current financial plan, your current wealth transfer plan, what already makes sense for you to do, irrespective of what happens next year. So what already makes sense for you to do, right? Whether there are changes or not, right? And then infuse that conversation with a little bit of a sense of urgency because things could change next year, right? And there's a corollary to that too, because not only are we not sure what's going to happen next year, but I think we can be pretty sure that particularly for the high earner, high net worth investor, things are not going to get more advantageous from a tax perspective, right? So that 20% capital gains rate, that's not going down, right? The lifetime exemption from the estate and gift tax, which is currently 11.7, it's not going to go up to 15 million next year. So what are the things that we should be doing and executing on, or at least talking about, that make sense and leverage the current tax situation we're in right now? So if a client, if you've already been thinking about selling your business, right, transitioning out of your business, retirement, right, now may be the year to do it, right? Because you're already planning on it, it already makes sense. Why not lock in the favorable capital gains rate when we don't know what it's going to be next year? If your advisors have been trying to convince you to diversify out of a concentrated position, right, to better balance your portfolio, now may be the year to do it because we know that capital gains rate is not going to get any more favorable for you. Those decisions make sense irrespective of what happens next year, but they maybe make more sense because of the potential for change. And so there are 3 areas of conversations that I would focus on right now with your teams of advisors. So first of all, check in on your basic estate planning documents, right? This is a great time to do it. Everybody's at home more. We're thinking about family health, finances. Make sure that your basic estate planning documents, so will, living trust, retirement plan beneficiary designations, that they're all up to date, in line with your current wishes, right? And flexible with potential changes in the law. Retirement beneficiary designations in particular, for the reasons I mentioned before, the Secure Act, policy uncertainties, that's an especially big part of that review, right? And the more retirement assets you have, the more important it is to do as soon as possible. Second area of conversations, income tax mitigation, right? This comes in a number of different flavors depending on your personal situation. The question I get all the time, should I be selling this highly appreciated capital asset because capital gains rates are going up? And the answer is going to be what I said before. If it already makes sense and you're already planning on doing it, what's the harm in doing it now, right? It probably does make sense to pull the trigger and get it done before the end of the year because we don't know what 2022 is going to bring, but it's certainly not going to get any better for you from a tax rate perspective. Second thing, right? Talk to your advisor about some of those vehicles that provide tax deferred growth that are maybe thought of as being used for a specific purpose, but are starting to become more flexible in their application because they provide tax deferred growth. So a couple of examples: insurance, life insurance. We think of as insurance as providing for those we love, right, when we die, right? So pure insurance. Insurance as an investment vehicle provides tax deferred growth. That is very valuable right now. Insurance also provides certainty from an income and estate tax perspective. If you have an insurance policy sitting in an irrevocable life insurance trust, when the proceeds come in, they are not subject to income tax or the estate tax. Talk about a technique that takes uncertainty off the table, right? If you have a $3 million policy sitting in a life insurance trust, you know $3 million will be available for your beneficiaries upon your death, right? So it's not only the tax deferred growth, it's the certainty it provides. Another example, 529s. Everybody thinks about 529s as providing for higher education, and they're great for that. But 529s also at their heart provide tax deferred growth. There's no age limit on who you can set them up for. There's no limit on the number of people you can set them up for. So I've been talking a lot about this large format off-label 529 planning where you're funding not 2 529s for each of your grandchildren, right? But you're funding 7 529s, right? One for each of your 3 kids and 4 grandchildren, right? Or all of your children and grandchildren, no matter how many. You can fully fund them to the plan maximum, which for our College America plan happens to be $500,000. So $500,000 multiplied by 7 or 10 or however many you set up, that's a really effective way to move money not only out of your estate, right, and get it out of the potential realm of the estate tax, but also put it in a place where it's providing tax deferred growth. That tax deferred growth, especially for somebody who lives in California, is very, very powerful. When you're talking those types of dollars, think about how much tax deferred growth accumulates and how much it compounds for as long as you leave it. So again, a non-traditional use for a very traditional type of vehicle that we think about in a certain way. Another technique that we're seeing come back from an income tax perspective, opportunity zones. This was one of the things we were talking about along with the Secure Act in 2019. It was a gain deferral technique that encouraged the investment in economically depressed areas, right? If you sold an asset, right, took the gain from that asset and invested into one of these opportunity zones, you got to defer that gain and potentially exclude some of that gain, right? If you invested in one of these opportunity zones. The pandemic got in the way, right? But now we're starting to emerge again, and we're hearing a lot about them, particularly for people that are interested in ESG, because these opportunity zones are in locations that are economically depressed, right? There's a big ESG push to get money in there, right? And get people invested. And so for people that are interested in ESG and are tax sensitive, opportunity zones are a really interesting thing to explore right now. And I think we'll hear a lot more about them in the coming months as things go back to quote unquote normal. Finally, third conversation, and then I'll wrap it up, is around wealth transfer. right? And this is a big one. If I had to pick one change, which I think is going to happen, it's a reduction to the exemption amount, right? From the 11.7 down to 3.5 million. Or if it doesn't happen this year, it's going to happen at the end of 2025 and go down to 6 million. So right now we have this almost 12 million exemption. So if you can afford to make a gift and lock in some of that exemption, as I said, it's use it or lose it. So if you can do it, there's no harm in making that gift now. There is potential harm in waiting because the exemption amount could go way down, right? And so we want to use that exemption while we have it. And I get a lot of pushback, or the first pushback I always get is, I don't want to lose control of the asset I'm giving away. I recognize the tax benefits, but I can't give up control of these rental properties. I can't give up control of my business. Other pushback, I don't want to lose access. Like, what if this ends up being a substantial portion of my net worth? An especially big concern for people who are on the younger side, 40s, 50s, 60s. Giving away something that could be big is a hard thing to do, even if it makes sense from a tax perspective. And then complexity. That's the other big hurdle. It's just, my eyes glaze over when I hear the word trust. Those three things, control, access, and complexity, should not be the obstacles that get in the way of some really good wealth transfer planning, right? The focus right now should be on using up exemption, lowering your taxable estate to hedge against the potential decrease to the exemption amount, right? And there are ways to get around all three of those concerns. And so this is a great conversation to have with Sharon and Denise, Lev, and their teams, right? Bring in your estate planning attorney and they can help guide you to the strategy that helps address the particular obstacle you're most concerned with. But there are really easy ways around all of those concerns. So don't let those get in your way. All right, I'm going to wind up there and hopefully we have time for another question or two. Denise, Sharon, Lev, any questions you've received that I can answer?
I have one question, Leslie. There's been some talk about the Secure Act and the distribution rules, and can you really wait until the 10th year to empty out the account if you're an IRA beneficiary, non-spouse? Or are they going to clarify that and make you take it out over 10 years?
Yeah, so this one was very much assumed to be settled, right? Up until the last few weeks when everybody was assuming that one of the small benefits one of the few benefits of the 10-year rule was that there wasn't an RMD in years 1 through 9, and that you could wait until the 10th year to take everything out, right? That was kind of assumed to be how the IRS would interpret this. Some guidance came out a few weeks ago that very tangentially seemed to suggest otherwise, that you did have to take an RMD in years 1 through 9, and then everything else had to come out in the 10th year. It looks like that the IRS just made a mistake and copied and pasted an old example from old guidance without revising it to adhere to and conform with the new 10-year rule. Big snafu on their part that created a lot of panic. Still a little bit unclear. I think they're issuing revised guidance very shortly if they haven't already. But from what everybody in this crazy tax world is saying is that it will likely be no distributions in year 1 through 9, just that one RMD at the end of year 10.
Interesting.
Right. And Leslie, a client had a question too, just about the multiple 529 accounts and setting those up, and you kind of if one of the grandkids or children had already paid for college and kind of strategies there.
Yeah, so the beauty of that is, first of all, 529s, you can always change beneficiaries, right? So the owner can always change beneficiaries to siblings, to lower generations. The owner always has that authority. So you can kind of shift it down through generations from family member to family member, right? So if one doesn't use it, you can pass it on to the next. The other kind of workaround is, even if money comes out 20, 25 years down the road for a non-education related expense, right? You pay the tax on the gain, you pay that 10% penalty on the gain, but think of the amount of tax deferred growth that you've accumulated in the interim, right? We haven't solved the tax problem, but we kicked the can down the road by a generation, which in tax planning is a total home run. So yes, you still pay the tax, you still pay the penalty if you pull it out for a non-education related expense, but the tax deferred growth and compounding should more than outweigh it, particularly for someone in California.
Well, I don't see any more questions. You've done such a thorough job of explaining these topics.
Absolutely. Thank you so much for having me.
Lev, do you
So-
want to wrap it up?
Yeah, so Leslie, thank you so much. This was really a fantastic presentation. Great insight into both federal changes and potential changes and state and local changes and potential changes. So I think really relevant to all of us, and really appreciate just a wonderful presentation. So thank you. Also want to thank Capital Group, for their continued partnership, really just such a valued partner. Thanks to Jamie and Adriana and everyone in this office for organizing and putting this webinar together. And really just want to remind you to please contact Sharon, Denise, or myself if you have questions or want to talk more, in the sense of urgency really around income planning and taxation and estate planning and wealth transfer. And we're here to work with you on that. And so please contact us. I think one of the things that really stuck with me is we don't want to make decisions on predictions, but we do really want to make decisions that make sense. But there's a little bit of sense of urgency right now as we start to see the changes happening. So we're really looking forward to hearing from you and working with you on this.
Thanks, everybody.
Yep. Thank you for joining us.
Bye.